Does community property impact married filing separately? Imagine sharing everything with your spouse during your marriage, from your home to your income. Now, when it comes to filing taxes, how does that shared ownership change things? That's what we're here to figure out. Community property laws are different from the usual way most people think about income and assets. In states that follow community property rules, any income earned or assets acquired during the marriage are considered owned equally by both spouses. This means each spouse owns half of what was earned or bought together, even if only one person made the money. If you live in a community property state like California, Texas, or Nevada, and you decide to file your taxes separately, you need to be careful. When you file separately, each spouse reports their own income, but there's a twist. You must also report half of all the community income on your individual tax return. For example, if your household earned $100,000 in total income, each spouse reports $50,000, regardless of who earned it. This rule applies to all income earned during the marriage, including wages, business income, and investment earnings. But it does not include assets or income that you owned before marriage or received as gifts or inheritance. Those are considered separate property and are reported only by the owner. To make sure everything lines up correctly, the IRS requires couples in community property states to fill out Form 9958, which explains how they split their income and deductions. If you don't do this properly, the IRS might flag your return, which could lead to audits or penalties. For families living in community property states, understanding this law is key. It affects how much tax you pay and how you report your income. Filing separately doesn't just mean splitting your own income. It involves sharing half of the community income, which can change your tax situation quite a bit. So, in summary, community property laws do impact how married couples file their taxes when choosing the married filing separately status. They requiring sharing income equally, which is different from the way most people think about reporting their earnings. Knowing your state's rules and using the correct forms can help you file accurately and avoid surprises at tax time.